Hello, everyone. I'm Matt Wright with Alliance West Mortgage here with your 2023 mortgage rate and housing forecast. Before we get into 23, I want to do a quick recap on 2022. 22 was a pretty tough year for both real estate and mortgage rates. Within the first 60 days of the year, we saw mortgage rates pretty much double, and they went higher through the rest of the year. And that put a pretty severe strain on affordability for a lot of home buyers, just because rates were so much higher. And of course, that in turn affected the monthly payments. Prices had come up about 40%, since the 2020. And so the higher prices and higher rates really put folks at a disadvantage from a affordability standpoint. In addition to the demand side of things, this also put a strain on supply because there wasn't a whole lot of incentive for current homeowners to sell and go buy something else. So that put a strain on inventory where, these homeowners were sitting on, maybe a 3-4% mortgage and looking at potentially buying a property that would have a 6 or even higher percent mortgage, effectively doubling. In addition to that, a lot of homeowners have, owned the homes for quite a while, and their property tax bases were really low. So, for somebody to be looking at doubling their interest rate, doubling, maybe even tripling their property taxes, just a really difficult financial decision to make. So a lot of homeowners just decided to stay put, and that really put a constraint on inventory. And so both supply and demand levels were really low, just a real sluggish year. Prices held just because rates were so low. We did see prices kind of start to push downward a little bit towards the end of the year, and I'm getting to that in a little bit. But that takes us to 2023, where I do feel like much more optimistic about this year, and I'm just going to dive right into why. A lot of that does have to do with mortgage rates coming down. But let me go ahead and share my screen, and we can get started. So, when it comes to interest rates, inflation drives mortgage rates. So I know that, there's you hear on the news, the Fed Reserve is hiking rates. That doesn't directly affect mortgage rates. The Fed rate hikes are used to combat inflation, and that affects the cost of money for banks that are borrowing from each other overnight. And so when banks pay more, you pay more, is basically how that works. And so the cost of everything else outside of mortgages would go up on top of the shortages that we saw and all that. So inflation has been running pretty rampant over the last couple of years here. And so as you can see on this chart, mortgages and inflation measured by a couple of different indexes, the consumer price index and the personal consumption index, tend to follow each other. So you see, here we got CPI going up, mortgage rates come up, mortgage rates come down, CPI come down. But what we saw in 2020 is the Federal Reserve got involved in the bond markets. And that is something that is called quantitative easing. It is a way that they can stimulate economic activity. So when COVID hit, they started buying government bonds, government debt, and mortgages like crazy. So over the 2-year period from 2020 to 22, they injected about $5 trillion in new money into the system at very low interest rates. And so the spending just went bananas. And so, when there's a high level of demand, all this excess money at low rates, people are buying stuff, and that puts upward pressure on prices. And so what we saw was, around the middle of 2021 is when inflation started to kick in. This $5 trillion of new money is, started to kind of take grip on inflation, and inflation started to spike. The Fed initially thought that this was transitory, which is basically a fancy term for transitional, as we transition out of COVID, which, caused prices to go up also because all the lockdowns, the factories were shut down, we had shortages, there were just supply chain issues all across the world. And so that also put upward pressure on prices and caused inflation, but also all this new money did as well. And so finally, they realized that, hey, we got to stop doing this because inflation is running wild. This is not transitory. And so they started to stop their mortgage and bond buying program. And now you can see here the QE, or quantitative easing period, ended, and we saw mortgage rates just spike immediately. So right in the beginning of 2022, boom, rates went up, pretty much double in the first 60 days of the year, continued to climb through the year. And then towards the end of the year, as the Fed is hiking short-term rates, these rates that the banks borrow from each other, which affects everything else, causing prices to go up. Their philosophy is that the key to higher prices is higher prices. So although we saw inflation running up, they also doubled down on that by raising the short-term rates, which caused things to be even more expensive because the cost of money was becoming more expensive. And so that, eventually, as prices get to a certain level, the consumer stops to spend, and then it comes down. That's what we're experiencing right now, and why we should start to see mortgage rates come down even further than they have already. And so from the peaks that we saw in November of last year, we've already seen rates come down about 1%, which is significant. So as far as inflation itself and how the readings are made, this is a chart of consumer price index, and it shows the month-over-month readings over the last couple of years. And so what happens is the measure is calculated by taking the last 12 readings month over month. So you add up the last 12, and that gives us this number here. So as of last month, core consumer price index was at 6%. So as you can see here, last year we had some pretty high month over month readings through January, came down a little bit to March, then right back up into June. And so what's happening right now is these month over month readings are going lower and lower. And so we actually had the CPI reading come out yesterday, and it was 0.1% for December. So that 0.1% now replaces this 0.6%. So the difference between a 0.1 and 0.6 is 0.5%. So CPI actually dropped to 5.5 yesterday. And so that is another positive sign. And as we saw, inflation in normal markets where the Fed is not influencing or manipulating interest rates, inflation will come down and mortgage rates will come down with it. So we further expect to see decreases in the CPI month over month, or in just inflation in general, and mortgage rates will come down with it because of that. The other thing about the CPI index too, and this is what the Federal Reserve uses to gauge monetary policy and meet their target. And so their target on this core CPI is 2%. So we've got a ways to go from 5.5 right now, but that's how they gauge it. And the problem with that is that they're always looking in the rearview mirror, because these reports are looking over a year behind us, not what's in front of us. And so if we look at shelter costs, which equate to 39%, almost half of the CPI index is shelter costs. So for instance, rents. We saw rents spike just almost uncontrollably last year, up in this big, huge roller coaster, and then they started to come down. And so when you're looking at an index that looks at the last 12 months, it's going to average out. And so what's happening, and we've got these heavy high readings that are influencing the average. And so the CPI index is calculating 7.9% increases in rent, when in reality right now it's 4.6. So as rents come down, or even plateau, or even start to rise a little bit, once we get rid of this, then we're going to start to see CPI come down even more, just because the weighting is so heavy in shelter costs. And as these higher readings over last year start to go away, and we start to see normalcy, then CPI will come down even further, bringing mortgage rates down with it. So all segments of CPI are lower except for shelter. So again, your prices on everything have come down over the last few months. These are all reflected in CPI right now, but the shelter cost, because they're looking at this average that has all these really high weighted months last year, is higher than it should be. And so as we start to see those months drop off, CPI will come down, mortgage rates will come down with it. So this slide, very, very interesting. I don't know that this has ever happened in history, but this slide shows the spread between the 10-year Treasury and mortgage rates, 30-year mortgage rates. So the 10-year Treasury or just Treasury are basically government bonds. They are considered the safest investment, fixed income investment that someone can make. It's backed by the full faith and credit of the U.S. government. So basically, if you invest in a government bond or any note, bond, whatever it is, you're going to get your principal back. You're going to get the interest that they're committed to guarantee. Next, from a risk standpoint, after that is going to be mortgages. Very safe investment, especially under today's underwriting standards. In addition to that, they're collateralized against US real estate. So it's a safe investment, but there is going to be a spread between those two different types of investments. And so usually the spread is between 175 to 200 basis points. And so that equates to 1.75 to 2% of difference between where the 10-year treasury is to where mortgage rates. So if someone wanted to gauge where rates are at, you could expect to see in a normal market that rates are going to be about 2% higher than the 10-year. But what we saw last year is the spreads went up to 300 basis points. So mortgage rates were trading at 3% higher than the 10-year treasury was. And the reason for that is the value of servicing. So when you buy a home, your loan gets sold off very quickly, pretty much immediately into the secondary market. They get securitized and sold to mutual funds and whatever. And it's funny enough, what happens is the actual person you're making your payments to is the servicer. They pay, and they may be your original lender and just kept the servicing, but there are also servicers, and the servicing of a loan has a value. And so in a normal marketplace, a servicer might pay, say, 100 basis points, so 1% of the loan amount, to buy the servicing rights of that loan. Now, the bondholder, say the mutual fund that owns the mortgage, they're paying a servicer an annual fee to service the loan. Say it's 30 basis points or 0.3%. So if you buy it for 100, you're getting 30 basis points a year. It takes that servicer, over 3 years just to break even. Now, when rates got up to 7% or over 7%, the value of the servicing was pretty much zero. The servicers are sitting there saying, well, I'm not going to buy this loan, this 7% loan for much of anything, because I know that this person is going to refinance as soon as rates come down, which based on what we're seeing right now is going to happen soon. So the value of servicing wasn't gauged in years anymore. It was gauged in months. And so a lot of these people that bought homes last year are already refinancing because rates are lower. So a servicer, they can't pay very much for a loan like that because they're going to lose money if it refinances that quick. So what happened is, instead of having servicing value separate from this spread, it was baked in because there were a certain amount of revenue that would need to be generated on these loans. And so, basically the servicing value was baked into the spread as opposed to being something separate. And so we saw the spreads increase. So as rates come down, and again, we've already started to see that already. We've already started to see the spread for servicing on the 10-year to mortgages come down as well. That will get even tighter, and this alone will bring rates on mortgages down. So outside of all the other things with inflation and rates, just coming down in general, this is another driving factor that will bring rates down in 2023, bringing more affordability to the housing market, more buyers, and lower payments. So there is a recession coming. A lot of question and chatter about, is it coming, is it not? The problem with recessions is that the Bureau of Labor Statistics, they don't tell us we're in a recession until usually we're out of it, for a year even. So, we won't know if we were or when or whatever we were in the recession until that happens. But it's here. I mean, there's just flashing red lights everywhere that are recessionary. And so I want to just kind of go over a couple of major things that are playing into this right now that are going to cause this economic downturn. And so credit card debt, consumer credit card debt, has been exploding over the last 2 years. And so you can see here from, the first quarter of 2021 to today, $200 billion explosion in consumer revolving credit debt. And so the reason for that is the cost of things are going up. Inflation is rising. Everything is more expensive. People are funding their lifestyle on credit. That is not a good situation. Eventually, that has to stop. You can only put so much debt on credit before you just have to say, I cannot live this lifestyle anymore. I need to stop. And so we're already starting to see that. You can see it start to come down at the very end here. So consumers are having to stop their spending habits. When people do that, prices of things come down because the demand is lower, and we start to see inflation drop, which is good for mortgage rates. But in addition to that, we're also seeing the savings rate diminish. So people are running out of money. So if you look at this chart, this is pretty interesting. These spikes here, stimulus. So stimulus check, stimulus check, stimulus check. And now all these savings are being depleted, and the credit card debt is rising. that's a recipe for disaster. It will hit a brick wall. I think it already is as I speak right now. And so eventually, prices will come down. This is recessionary. And so, and I keep mentioning recession because historically, in almost every recession, mortgage rates do really well in recessions. In addition to that, coming out of a recession, home prices usually do really well because rates are lower and there's more affordability. So unfortunately, in recessions, that comes with unemployment. So there will be some suffering. It's unfortunate for a lot of folks that will lose their jobs, which is starting to happen right now. We've seen all major tech companies announcing major layoffs. A lot of S&P 500 companies are laying people off. So it's here, it's very present. But again, recessions are good for mortgage rates and generally good for housing when we're coming out of it. Another flashing red light from a recession standpoint is that the yield curve is inverted. And so just to explain what yield curve is, if you were going to invest in a 10-year bond, bond, essentially, so that you would expect to get a greater interest rate than if you were only going to invest in something for 3 months. So the shorter term maturities, usually in a normal yield curve, are going to have a lower interest rate than the longer term because your money's locked down for so much longer. When the yield curve inverts, it means a lot of things, but mainly that a lot of investors feel that, although inflation may be high right now, I'm going to secure this money long-term in a safe investment. And I'm okay with taking a lower interest rate than the short term, because in the long term, I feel like inflation is going to come down and the return being, lower right now or compared to where the inflation rate is okay, because in the long term, I'll be all right as inflation drops. So that kind of activity, and then when the yield curve inverts, is indicative of a slowdown. And there's also what we call a flight to safety, where when the stock market is selling off, investors are looking for safety, so they buy long-term maturity bonds, and so that drives the interest rate on these longer-term maturities down. And so just to show you why this is so important when we're evaluating when a recession might be coming, is look what happens when the 3 month versus 10-year yield curve inverts. So look right here. Here's the zero line. When it inverts, when it goes under zero. So inversion, recession, inversion, recession. These bars are recessions, by the way. Inversion, recession, inversion, recession, inversion. Look how low we are. It is so inverted. It's the most inverted it's been in 40 years. So the recession's here. I mean, it's here. So again, this is good for mortgage rates. And so I would expect to see mortgage rates coming down this year for all of these different factors, which will be also supportive for home prices. I can't tell you how many people, pre-approved buyers that we have that are sidelined waiting for rates to come down. So once those rates come down, they're going to come back to market, more demand. The supply problem really isn't going away. I think some people will finally be incentivized to move. If they can get a 5% mortgage and they're at 4%, that's pretty close. Let's do it. So that's, probably going to be a circumstance that brings more inventory to market, but there's going to be a lot more buyer demand. Another reason for an increase in demand is household formations. So over last year, we've averaged about, 1.7 million household formations. And a household formation is when you have a family, they're all living together. One of the family members becomes of age that wants to move out on their own and start their own family. They want to buy a home. That's a household formation. And so what happened over the last few months is that formations dropped because affordability of housing was high, or non-affordability. So the rates were high, a lot of, media was, saying all these things that were making people scared. And so we saw a big drop in household formations that people are just sitting tight and waiting. And so as rates come down and these people that would have been creating households over the last few months say, oh, well, okay, rates are lower, housing market stabilized, maybe it's time we should go out and buy a home. So as we start to see these formations catch up and the new household formations go to market, that's supportive of home prices. As far as, this crash, the media is really, taking this just to a crazy level, saying that, we're going to see a 2008. It's just not going to happen. Home prices have gone up about 115% in the last 10 years. 39% in the last 2 years. So if you look here, even when rates were at 7.5%, on a national level, we only saw home prices drop about 2.5%. So when rates come down to where they're at now, like say 6%, or even further down to 5%, we're not going to see prices drop. And so, again, just more supportive of home values and with lower interest rates. And just the fact that there's no real justification to say that there is going to be any type of a housing crash, because the numbers just don't show it. So don't expect it to happen. Affordability, this is a really cool slide and really interesting, because I'm going to show you here how, for many people, 2023 is going to be a more affordable housing market than it was in 2021, when prices were lower and rates were lower. So let's say in 2021, you got a home buyer that's looking to borrow $600,000 to buy a home. They've got a rate of 3.5%. The monthly payment on that loan is $2,694. Now, the next year, say home prices went up 10%. Now they need to borrow $660,000 to buy the same home. Rate 7%. Payment at $4,391. They're paying $1,700, almost $1,700 more. That's a tough pill to swallow. And then, say their household income in 2021 is $12,000. And so this is where it gets interesting. Based on ADP, the largest payroll servicer in the country, people who stayed at their jobs from 2001 to 22 experienced a 7.6 increase in income. People who moved to switchers experienced a 15% increase in income. So average 9% increase in income. So this $12,000 a month household income is now $1,080 higher. So they're making $13,080 a month this year. Still, when you consider inflation, they're paying a lot more for all these different things. The home price is still high. It's still very tough to justify. So jump to 2023. You got a $660,000 home. Rates, let's say, drop to 5%, which I think is very realistic. You've got a payment at $3,543. They're now paying $849 more than they would have in 2021 with the lower rate, lower mortgage. And on the other side, let's say that they conservatively, modestly have a 5% increase in income. That increases their income by $1,300 a month. And so now they're making $13,734 a month versus the $12,000 in 2021. If you look at the difference between the $12,000 a month here and the monthly payment here versus the income here and the payment here, they have more disposable income after the mortgage is paid in 2023 than they did in 2021. And as prices come down on goods and services due to inflation coming down, this creates a more affordable housing market in 2023 than we had in 2021. Very interesting to see that. So as far as housing forecast, I expect lower inflation. We're already starting to see it. It's happening. It's going to continue. Recession-like slowdown. The economy is just going to slow down through this year, maybe into 2024. The Fed's going to hold the Fed funds rate high through this year and potentially maybe start to reduce it in 2024. Incomes increasing to help affordability. Very tight inventory still. I don't really see a solution to that in the foreseeable future. And rents, even though they're dropping, they'll plateau and eventually start to go back up. So low single-digit appreciation, I think, is realistic for most of the U.S. with a pickup activity, both inventory and buyer demand. As far as mortgage rates, the headwinds that we're going to run into is global quantitative tightening, which is potentially our Federal Reserve. They're sitting on trillions of dollars in government bonds and mortgages. If they started selling those to market as opposed to just not doing anything, then that could create upward pressure on interest rates. And that's happening all across the world. Lack of central bank buying. We have all different types of countries that buy our government debt. If that stopped or they started to limit that, then that will put upward pressure on rates. And there's more debt to be financed by our government. Tailwinds, lower inflation, excess retail inventory, because as people stop spending, inventories will level pick up. And when there's excess inventory, prices come down. Increase in mortgage servicing value. We talked about that. We're already starting to see it. That's going to continue and will influence rates and bring them back lower. And the likely recession. Again, mortgage rates tend to do very well in recessions, creating more affordability for housing. and more buyer demand. 30-year fixed mortgages, I wouldn't be surprised if we saw low fives, maybe even under five, depending on how it all plays out. Obviously, there are a lot of factors that contribute to this, and we'll have to see what happens. But I do think that's realistic. And a 10-year, close to 3%. So again, if we saw a 2% spread, 3% and 2% spread is 5%. So again, I think that's very realistic to see this year. So that's it for what I was hoping to discuss about the housing forecast today. Thank you for listening. I wish you a happy, healthy, successful 2023. Any questions or concerns about this, feel free to reach out to me. I look forward to a great year, and thank you.